Hello, everyone. Welcome back to a brand new episode of Take This Week. My name is Apulak. Hope all of you are doing well. So, today, what do I have for you? Today, I have a story which does not directly talk about technology, but it talks about an incident that has shook the banking world. Yes, I'm talking about the recent developments which took place at the HDFC, and it's been there in news for all the wrong reasons, right? First, the chairman resigns. I'm sure for all of you who have followed the story, for the chairman resigns reportedly over differences around values and ethics, which has actually resulted in a knee-jerk reaction by the stock market itself. The market plummeted. Then the news came that the three senior officials of the bank were removed over compliance gaps at their Dubai branch. And suddenly you start tying the dots and you realize what looked like a leadership tussle uh, probably had much more to say than just that, because if you've read the story about the three senior officials being, removed at the Dubai branch, what happened essentially was uh, there were alleged mis-selling of, high-risk AT1 bonds to NRI customers, and they were promised that these what they were being sold to were actually safe instruments like FDs. So when you hear something like this, the immediate reaction is usually, how does this even happen with such large and respectful institutions, right? That's the first thing that comes to my mind. I bank with such banks, right? So that's a very, very obvious question, but the truth is, and this is, please be with me. I need your attention. This kind of thing happens far more than one would think. And it's just not in banking, right? Think of a salesman, in an electronic store, convincing, say, elderly customer to buy the most expensive phone, even though they definitely know that they don't need that phone, right? Think about a car dealer pushing unnecessary add-ons for commission. Think about a real estate broker saying, prices will double within 6 months, buy it immediately. Or even if something as a waiter, pushing the most expensive dish on the menu because they've been asked to increase the average billing, right? So what am I hinting at? Uh, aren't these behavioral traits? When everywhere the pattern is the same, please, people do not always sell what is right to you. They sell what is right to them. And usually, two things drive this behavior. Could be many, to my limited understanding, two things very clearly: pressure and greed. Pressure because there are targets, greed because there are incentives. You know, greed works at an individual level, pressure works at an institution level. And this is where, internal misconduct begins, not with one massive fraud, but with small compromises. Every, step looks harmless in isolation, but together they create a system where mis-selling becomes normal. It's normalized. And that is why such issues are so difficult to detect, and it often looks business as always. Yes, this is a repetitive take this week, and I should bring in, can technology play a role? Well, before I say that, think of it. When you think of the use of technology, say for a bank, most of the times it is protecting the bank from external fraud, right? That's mostly the case. So they have the best of the world. They have, cybersecurity protocols, XYZ, everything. But what about the risks from within? How come we don't hear so much about that? But coming back, so I wanted to make this point very strongly, but addressing the problem at hand, when we speak about, mis-selling, behavioral challenges of, overselling because of pressure and greed, does technology have a role? Uh, Technology can have a role partially, but you have to understand technology cannot remove behavioral antics like greed or remove pressure. But what it can do is to make, unethical behavior hard to hide. For example, banks and use AI to monitor employee behavior patterns over time. Not to read every message, understand, or spy on every employee, but to identify unusual patterns that may suggest internal misconduct. For instance, if one RM, is suddenly selling very high number of risky products compared to everyone else, that should raise some questions. If one employee is repeatedly selling complex, banking instruments to say elderly customers, first-time investors, or customers with low risk appetite, right? That should trigger alert. In short, yes, they can help banks spot behavioral red flags earlier than what meets the human eye. All in all, like I said, technology can help tackle such issues. But the real question, please, my friends, the real question is, will banks willingly put these controls in place? Yeah, I don't know. I don't have the answer. But what my cynical mind tells me, probably not, because the moment you make sales harder, revenue slow down. The moment you create stronger disclosures, conversions rate fall. And the reality is that banks are commercial institutions, right? Historically, the banking model has always been designed to protect the lender first and the customer second. Agreed? Is one of the oldest professions in the world. That is simply how the economics of the industry operate. That is why you have to understand the regulator matters, right? In our case, RBI. You know, customer protection cannot depend on the goodwill of the banks, as we can clearly see. Regulators need to step in with much stronger rules. Like uh, mandatory product risk disclosures, stronger penalties for mis-selling. Etc. Because in a country like ours, rules often, unfortunately, work only when they're enforced. You know, I'll give you an analogy. Very few people wear seat belts voluntarily. Most people wear them because there is a fine. And maybe, hopefully, going forward, our future, it will become a habit. But it's a journey, right? The same logic applies here. Banks are unlikely to voluntarily put strong guardrails in place if those guardrails impact their profit margins and conversions, even for a short term. So this is one area where we may say that India is a great country, yes, but I am one of the big strongest proponents of India being great. But this is one area we really can learn a lot from much more mature capital economies of the West. Countries like US, most European nations actually, US and Australia, there's much more focus on customer specific risk assessment, product transparency, and financial advice standards. And not just for banking, for every customer, customer is protected much better in those countries, because not because they are a perfect system, because they've cracked one simple code, because mature capitalist systems understand one simple thing: protecting customer is what keeps the business sustainable in long run. And that, my friends, is the biggest lesson from the HDFC Bank story. This is just not about one high profile resignation, it is more about trust. Because in banking, the moment customers stop trusting your institutions, it can derail the entire ecosystem. And trust, cannot be based on just one brand name. It needs to be based on accountability and transparency. And unfortunately, for a country like ours, it has to be enforced. And that's where the regulator comes in. That's it from my end. Have a lovely week ahead.